So in the spring, we'll talk about how this is so, especially for financials. Financials, we don't really use the term free cash flow. It's really dangerous. I don't know anyone in finance uses the cash flow statement and the cash from operations for banks and insurance companies. It's actually pretty dangerous because what they show as cash flow for finance and banks is really taking on more risk. It's, they're taking on more, and it's gotten really tricky. I remember when I was at USAA, the accounting for annuities changed pretty dramatically. When a life insurance company sells an annuity, that sounds like a revenue, but the county said, no, that's not a revenue. It's really borrowed money. So it really changed. A lot of cash flows in CFOs suddenly shifted down to the financing side. So it can get pretty complex. All right, let me check the volume here. Sorry. Can I hear that? Testing. All right. I'm going to sue Zoom when I retire. It's just really tough. So there are some things here, especially, for banks, insurance companies, it's going to be a lot different, but the categories are the same. But USAA, we spend a lot of time, every quarter we talked about liquidity. We went through every liquid kind of, I don't know, source that we had. Every quarter we tested them. We actually borrowed money when we didn't need to borrow money just to make sure it was in place. We spent money. Solvency looks different. Banks have their asset ratios, their capital ratios. Insurance company has capital ratios. So the main categories are the same. When it gets really unique, it's inside what you actually measure. It looks a lot different. Like banks don't fund themselves. Insurance companies don't fund themselves with debt. They fund themselves with products, with deposits and annuities and those type of things. And then insurance companies and banks don't have turnover, asset turnover. They don't. What's the margin at a bank? Anybody know that term? Not gross margin. Initials are NIM. Does that help you any? Net interest margin, very different thing. They do have net margins, so you can do that. I was telling Dr. Kadbackham, I tried to do an ROE decomposition at USAA. I got it to work out, but it wasn't multiplicative. You had to use some addition because in insurance and banks, there's no such thing as revenue to assets. You would never do that. You got the business revenues and the investment revenues, and you always separate those two. And so you have to do addition. So, but the basic blocks are there no matter what industry you're in. So you want to make sure you've got a template, a basic template. It was funny at USAA, a guy came in and taught a book on all of this. And they asked me to come teach it with them to bring in the insurance side. He knew nothing about insurance, and we had to radically change it. So it is in the details. If you're looking at insurance or banking, your terminology is very different. All right. How
would you change it for insurance theoretically?
Well, insurance is even more difficult than banking, so you'd have to, that was the whole life. If y'all want to learn more insurance, not a hint to people interviewing this week, but just go into my YouTube channel and find UTSA Life Insurance Fall 2024 and go to class 25 and 26 and look at their asset liability management. And there's a problem in there that actually is pretty basic. It shows you how to do it. This is when you know life insurance. Did any of y'all take my life insurance class? So when you want to impress someone in life insurance, you say deferred annuities are like a short straddle on interest rates. And if you understand that, how many of y'all can explain that? You can explain that, you know life insurance. You know what a short straddle is, right? What does it look like? What letter?
It looks like the letter N.
V except for what? A long straddle looks like that. What does a short straddle look like?
Right.
No, it looks like that. What does that mean with deferred annuities? You make a lot of money as long as what? Interest rates don't do what? Don't move much. All right. So I remember the first time we showed this to our CEO. We were doing stochastic modeling of our life insurance company, and he saw that. He said, why in the world would I ever sell that product? And they were like, yeah, but you make a lot of money when it's up. When it's down, yeah, you can, the whole firm goes under. But yeah, life insurance looks like a short strut. So that's pretty impressive, right? I teach my life insurance company, especially the actuaries, and bring that up in an interview. Yeah, those annuities, deferred annuities, they're pretty dangerous. They're like a short strut on interest rates. If interest rates get volatile, those products blow up pretty dramatically. So anyway. All right. So last class, or class before last, I gave you the pitch book. I said, and we're trying to get some volunteers, hopefully this week, right, Josh? We can get people assigned. We'll have to figure it out somehow.
Yeah, I
Try to get
a list somewhat.
We may just have to randomly assign them or something, draw straws. So the first thing I said is annual report to business description. So here, let me show you for McDonald's. Here's their annual report. And on page 8, they have the business summary. And it's very interesting because people debate, is McDonald's a quick serve restaurant? How many of its stores does it actually own versus how much is franchise? And then how much of McDonald's business is real estate? You don't see much. A lot of people say, oh, McDonald's is really a real estate company. They lease out, they actually buy the land and building, they lease it out to their franchisees, but you don't see that in this business description. So, but there's their business description, goes on for several pages. So that's a good place to start. So if you have, 4 stocks that you're looking at, you might, if you have someone assigned to you, you might say, hey, why don't you do this, summarize this part for me. So that's the annual report, just read through it. The second thing was do a value chain management. So I did that for Starbucks. I let ChatGPT do it. I thought it was pretty good. Value chain management analysis for Starbucks. They even brought in Michael Porter's name. So, value chain, you have your primary activities and you have those infrastructure activities. They go through each one of them, what you're looking for. And this is the key. You're looking for those economic moats. What is it that distinguishes this firm from other firms? So if you had to tell someone, I don't drink coffee, so I don't know the difference between Starbucks and Dutch Brothers, but you had to explain someone what's the key difference in those two firms. Could you do it? Do you understand it? What is it that they do?
One is espresso specific, the other does drip top.
Okay, I don't know what that means. So, but you can see it brought in a fairly detailed discussion in those categories. And you're not going to put all of this. Last week, you did a great job presenting. Some teams said, here's our Porter analysis. You can do that. That's not real that normal. What you normally do is you do a Porter's analysis and you pull pieces of it into your presentation. You don't feel like you have to do the entire thing. Same thing with the value chain. You're looking for those pieces that really distinguish the firm. So your goal is to see how can I explain this firm in a paragraph or so that people really understand it. And I added something down here at the bottom, which I actually think has been really useful to me. Is go on to YouTube and type in the CEO's name and watch an interview of the CEO. I would like to show you Costco's, but I can't find it, but it's a pretty amazing. Costco has had some really famous CEOs, and there's one, I can picture him, I can't remember his name, but man, he just says the goal of Costco is to make as little money as possible. And it's just, you hear him talk about this is a turnover company. They want those margins thin and they want really high turnover, and they kill everybody on turnover. And if they can get a savings anywhere, they pass it on to their customers. So their goal is they want their customers to get the cheapest price. They're going to give as much value back to the customers as they can, and they're going to make it up on the turnover. You can't, and what's the other thing you can say about Costco versus Walmart and the others? It has a limited what? Inventory, limited SKUs. So it's really interesting on the SKU, listening to acquired. I don't know if people have listened to some of the acquirers, but on Costco, because their SKU is so limited, you would think they're not as big as Walmart or Amazon, but because their SKU is so limited, they are the biggest buyer for some large suppliers. because they don't have 15 options, they have one option. And so they buy so much of that one option, they really control that supplier. And then I brought it up last week, and then y'all heard Austin bring it up as well. They acquired. I thought it was amazing. They acquired said Costco buys so many chickens, they decided to start their own chicken ranches. That to me is pretty shocking. When I see a firm do something like that, it's pretty interesting to me that something's changing. So find the CEO. Most CEOs of big firms are going have talked publicly. Now it gets a little challenging. You can see like in the spring when we do banks, it's hard to find. Jamie Dimon talked about everything but JP Morgan. You have to find him talking about JP Morgan. He wants to talk about the economy and the politics and all that. So if they're too famous, you might have a tough time getting them talking specifically about the firm, but you'd be able to find it. A couple of semesters ago, we were looking at Bristol Myers, kind of an interesting firm. Their CEO was in an hour-long interview, and he said stuff is like, man, I don't want to be in this firm. He said stuff that made me really nervous. When it comes to healthcare, I want to be in a firm that's actually part of the solution, not part of the problem. He was like, hey, we're going to be a really good part of the problem. Like, no, that's not my idea. So hearing a CEO, I think is really, really helpful. SWOT analysis, the UTSA library does have really good sources on SWOT analysis. If you're using Natasha's stuff, remember, send her a thank you. I think our librarians are terribly unappreciated, and they do a lot of stuff for us. So SWOT analysis, you don't necessarily have to put a SWOT analysis into your presentation, but you want to do one just in case you can find something. My view of SWOT analysis is this SW is usually very firm specific, and the OT tends to be very industry related. Most strengths and weaknesses are very company specific, and opportunities and threats tend to be an industry thing. But find them. You can find SWOT. You can do ChatGPT just as well. Are y'all using ChatGPT? And find or DeepSeek? Have y'all tried DeepSeek? I haven't tried it. You can load that on your phone, right?
I think you can't do it on the UTSA network fairly. They're restricted.
I haven't tried it. I've been tempted to.
It's good though at home. I've used it for other programs.
One thing that's really helpful is the analyst reports. If you go on the Bloomberg, they have the analyst reports there. Let me show you a few that they had. So here's one from Deutsche. We haven't talked too much about the sell side versus the buy side. So which side is this? Sell side. Yeah, I showed this one the other day. Oh, no, it wasn't this. It was another one, but it was this one. They saw that. So it must be the buy side. No, this is the sell side, but they're recommending the buy, which they do about 80% of the times. So how do you know it's the sell side? Because it's published and fancy. And the buy side, what does it look like? Looks like, if you have 1,000 analysts, there's 1,000 examples of the buy side. So this is the sell side. How much stock does the sell side buy? How large are their portfolios? 0. Yeah, the sell side is consultants, right? They don't buy stocks. They make recommendations. So now JP Morgan is on the buy side and the sell side, but the two sides are completely separated. But you should get used to looking at this. We're not doing this semester, but when I taught this class before, you're doing one company. The last paper was an exec summary, and I told the class, make your exec summary look like a sell side analyst report. So what does it look like? You can see the pieces. You have a recommendation, you have a price target, you have your discussion, and it almost always looks like this, where you have like 2/3 is the text and 1/3 are charts. You have your analysts up here. I should have found one with the UTSA alum in there, but I didn't have time to look for them. But you see the analysts. Now, if you have a lot of guts, you could, if you're recommending a stock, you could certainly try calling them. You try emailing them. As shy as I was at USAA, man, I did that all the time. And guess how many times I got yelled at? Never. People are like, it's funny when you call someone, it's just like they feel like, yeah, this person's calling me, they must have some authority to call me, and so they just start talking, and it's pretty amazing. So yeah, I got in the habit of just calling people. The guy wrote an article in the Financial Analyst Journal. I thought it was really, really interesting, so I called and talked to him. He talked my ear off for over an hour. He was having a debate with Dr. Ibbotson, and each episode they were going back and forth. And the guy I called lost the debate really horribly, so he was really sensitive about it. But he talked my ear off, and I was like a nobody just calling, and it's pretty. You should try it. It's pretty amazing. But you can see this is what it looks like. It looks really fancy. I've shown some of these to class where you read it, and some of them are horribly written. So some of these people on the sell side are not good writers, but JP Morgan's good. You can get these out of in Bloomberg, there's an analyst research. You just click on that. What you generally want to do is try to find one. They'll generally write them after earnings releases. So if your last earnings release was 2 months ago, it's kind of out of date. So you want to get closer to the earnings release.
Why isn't it like publicly available? Or is it only through
Bloomberg? Well, this is what they publish. This is what they're selling to their customers. So Bloomberg restricts what we can. We don't get access to everything, but so y'all have to. The world's changing, but have y'all heard of soft dollar? The SEC has changed the rules, so you get this for free from the bank, but you pay for it by giving them trades and other things, and so you're kind of soft dollar it. So it looks like at USA, it looks like we're getting it for free, but essentially our customers are paying for it because we pay a little bit higher fee for trades or stuff. But it's soft dollar. But the rules have changed, and that's why the sell side has been a little bit shocked. You're not supposed to look at this, but I'm showing it to you anyway. So this is a good way to look at. You'll find pretty quickly that they will, maybe not so much with Starbucks, but they will use jargon pretty quickly. They might say CPG. Do you know what CPG is? Consumer packaged goods. So they use jargon like that, and you just have to go figure it out. You can usually look it up, but sometimes those 3 letters can mean something completely different somewhere else. So you might have to do a little bit of searching. So they're writing not to you, they're writing to people who are analyzing these companies that know everything. So they can get pretty technical, probably not with the retail stocks, but when we do energy and when we do financials and in the spring, you're going to find some of these reports are really unreadable. And some of the technology side, they'll get very, very technical really, really fast, but they are really good for making sure you understand it from an investment standpoint, because they're writing it to investors. I used to like it because you get some interesting charts you've never seen before. The sell side, I was always, as an analyst, the sell side, they would come in. USA was a good draw for the sell side, probably Victory Capital. So they would come in. A lot of times they'd come in with like $300 worth of barbecue. So they kind of bribe us or something. I don't know why they were. So they come in, you go meet with them. And I remember my very first meeting, I was scared to death. It was a real estate investment trust sell side. I was like, okay, this is my first meeting. I got to get one question in and it not sound stupid. And so my first question was, this is actually a company visiting. I go, why do y'all have so much short-term debt when you have long-term leases? And he goes, good question. I was like, I don't know what his answer was. I was just like, it wasn't a stupid question. I'm not opening my mouth again in this meeting, but yeah. So companies come in, the sell side comes in, the sell side takes us to lunch, they bring all this food, and we're their customer and they're our consultants, and they come in. We don't pay them directly, but you pay them indirectly through soft dollar arrangements. And this is what they do. So Ryan did this. I'm really trying to get Ryan to speak to us this semester once we get through all the stock pitches. But Ryan said he was on the consumer retail side. He's still there now, but he went to the buy side, but that he followed 10 stocks. You imagine working 1,900 hours a year and you only have to look at 10 stocks. That's almost 200 hours of stock. Are you going to know that company pretty well? I mean, you're going to know every single thing about that firm. And they're the ones writing these reports. So that's the sell side. Here's one on McDonald's. McDonald's grinding out results in a still tough market, value and increased focus to regain core customer traffic. I don't know what value they're providing right now, but that's their argument. Their price was $307. Their target is 310, so I imagine they're gonna put a hold on this. I like the way the meeting entertainment did it. They started their industry. Saying you said we're initiating coverage. That's a good way to start it. You know, for college that you know, when you say initiating coverage, that's better than saying, I've never done this before, this is our first time to do it. It sounds better to say we're initiating coverage, right? It just sounds a lot fancier. So we're initiating our coverage on McDonald's or on the retail restaurant business. So anyway, that's what the sell side looks like. We're not doing written, but this is what you would like to have in your arsenal, a good sell side. So go look at these, see what they look like. You might, when you do one of your stock pitches, might try writing a sell side and then converting that to a PowerPoint just so you have one in your arsenal and be able to show. If you're really serious at getting to the investment banking side, it would be good to have something like this sitting on LinkedIn because you just show that you understand the sell side, what goes into it. You notice it's not, I mean, this one's really long, but the actual writing is not that long. There's just a lot of appendixes at the end, which is a lot of numbers. So the actual writing itself is not all that significant. And there's stuff like that I find interesting that they have models where they have, you know, red and green kind of rankings. We'll do kind of some stuff like that, but not necessarily that extensive. And then I showed you some of those files at Bloomberg. I put a couple of those out on Canvas, the Bloomberg Cap IQ, where you can just change that ticker and it gives you a really, really nice summary. You could probably use some of those charts in your pitch book as well. And then Bloomberg came in this week. Richard, right? No, not Rodney. Rodney came in. Bloomberg is introducing some new AI stuff. I think Dr. Patterson was there too. Some pretty interesting stuff. The most interesting stuff was the beta that we don't have access to. So hopefully, but they have AID and KI. Here's one for the AID for NVIDIA. And it just essentially it's AI going out just to everything Bloomberg has and creating a summary report for NVIDIA with links that you can click on other things. So interesting stuff. We've struggled with NVIDIA. We keep writing about it in our podcast, and AI cannot pronounce NVIDIA to save its life. She kept switching for NVIDIA and NVIDIO. And I don't know why they can't save that firm. So I don't know how else to write it out. So AI doesn't do well with just the word NVIDIA. Here's the KI. So the KI just has a list of articles and links that you can do. So KI is good. One other thing that they have that I found really, really fascinating is news on. So you just go up to the top in Bloomberg and say news on. You can say news on Costco. You can even say news on Costco March 2019. So if you know your firm did a major merger and acquisition on March 13, 2019, you can do news on your firm March whatever 2000, you know, and it will bring up articles just on that day. This is really good. I've had a really tough time with Bloomberg News finding specifically what I know needed to find, and now that news on really is quite effective and does bring up the stuff pretty well. So Bloomberg is a great source. So our goal this week is to finalize your screening. We did it today with media. They had a little bit of tough time at finding enough stocks, so we're going to have to expand it out a little bit, but they have their model run. So this week we're going to try to run your model so we can get all the stocks for the semester so you can make sure you can start analyzing. But this, if you have stocks on your stock list that you're analyzing, these are the things to start with. And your real goal is what makes them different? What's unique about this firm? That's the reason I'm trying to get Jason Bonet to speak to us, because he does it better. Everybody know that you just ask him about a company and he can in one paragraph explain what is about that company makes them unique, whether it's good or bad. It can be either direction. Jason Bonet, he's a tech analyst. I'm trying to get to speak to the class. No, he was at USAA, but he moved, but, he communicated, he said he'd do it, and then somehow his email's not working, so I'm having trouble getting back to him. All right. Any questions on all of that? So tonight, what we want to do is talk valuation. And I'm going to assume you've never had it before, but you've had it a bunch of times. So this is the part, these kind of questions I ask in interviews. Say, hey, you have a company, you want to value it, what would you do? So let's go through what you do. This is pretty basic, right? You had it in 3013, then you had it in principles and investments. You may have had it. Do you valuation?
Yeah.
Yeah, so you do it in many, many classes, but here's a chance to bring it all together. So let's think in simple terms. Dividend discount model. Probably the most famous, also known as what? Gordon growth model. I don't know why Gordon gets all the praise for this model. It's pretty straightforward. It's just a perpetual growth annuity. So anybody remember this basic formula? Times 1 plus growth.
The power of dividing by.
I heard Emilio's voice. And then what? Minus growth. All right. That's just a perpetual growth annuity, right? The value of an asset is cash divided by K by the rate. If it's growing at a constant rate, then it's just the rate minus the growth. That's all it is. That's a perpetual growth annuity. What's your cash flow? Well, for a stock, it's dividend, but dividend zero is the dividend they paid in the last 12 months. You can't get that. How do you get the dividend next 12 months? You put a growth rate on it. So it's, you know, very, very simple formula. Is dividend zero the right number? We really want free cash flow, right? We want the cash they're producing that can go back to stockholders, whether they send it back to the stockholders or not. They not reinvest it in the firm. So we're using it as a proxy, as Dr. Damodaran says. This model with dividend zero works for about 5% of the companies out there. It might work for like a Campbell Soup. Campbell Soup's dividends probably pretty close to their free cash flow. But for a lot of firms, it doesn't work. And for some firms, like an Alphabet that doesn't pay dividends, it's, you know, you can't do valuations all. But let's stick with this formula. So KE, how do we get KE? Cost of equity, and what is the cost of equity? We'll use the CAPM. Who created a CAPM? William Sharp. Dr. Sharp, right? Is he still alive? No, he's still around as far as I know. I think I would have heard. Markowitz died. Yeah, I talked about that presentation I made with two of the guys in my presentation had just died just a couple months before. It was like, this is a dangerous presentation. But yeah, Markowitz passed away, but Sharp is still kicking. It was interesting. We saw Markowitz here in San Antonio several years ago. My boss's boss goes, Dr. Sharp, what are you working on now? And he said, I've gotten out of finance. The math has just gotten too complicated for me. I was thinking, man, I have no hope. Sharp is dropping out. So, but he's been working. He's still doing a lot of stuff. His big focus has been on the payout part of retirement. We've spent so much time on accumulating assets, but no one's working on how to pay it out once he retires. So he's doing a lot of stuff like that. It's really interesting. So what did Sharp come up with?
The market minus
Yeah, market risk premium. Yeah, I tell you, in practice, I see it in classes. They do expected return on stocks minus the risk-free rate, but in practice, you just say the market risk premium. You don't do that parenthesis thing at the end. All right. So that's really all you need. You need a cash flow. There's your cash flow. You need a growth rate. You need a discount rate. How much simpler can that do? Now, is that what we do in practice? So I had one firm came in and spoke to me. It was an interesting firm. I asked them about, what discount rate? And they said, we use discounted cash flow. What discount rate? Oh, we just use 10% for every company. Like 10% every company. That sounds like, did you skip undergraduate or what? It's like, no, we just use 10%. We use 10% for Walmart and for Ford.
Were they talking about the back rate?
No, well, they're talking about the discount rate for stock valuation. For every stock, they use 10%. So, okay, that's kind of strange. Is CAPM the only model out there? There are other models, right? So CAPM's a one-factor model. There's multi-factor models out there. You'll see a lot of hedge funds that do, you've heard of probably Barra and some of these other models and French and all, there's a lot of adjustments you can make. That's really important that CAPM is a one-factor model because we're going to talk about beta and how we adjust for beta. What's the risk-free rate? Most people say 10-year treasury. Does it have to be the 10-year? Yeah, I mean, it's according to Sharp, it's whatever interest rate this diffuses your liability. Or I think it's Cliff Hassens. Whatever treasury diffuses your liability, if that's to be what to use. But yeah, it's an ALM argument. So 10-year treasury, does every firm do that? So USA got a new CEO, and I was so excited because I'd gotten a really strong relationship with him. He wanted to set USA's cost of capital. Like, man, I'm ready. I've been doing a lot of work. I did USA's cost of capital for the actuaries for filing with the states, and I was ready to go. He's like, no, Ron, get away from me. You bother me. We're going to use 5-year treasury plus 5%. How'd you get that? I got it from my smart brain. You don't need my help. I don't need your help. He said 5-year treasury is 5%. Is that the right answer for him? That was the right answer. I didn't argue with him. It's like, okay. We had some students at Tesoro, and they were assigned to updating Tesoro's cost of capital, and they got so excited. They called me. I sent them all kinds of stuff, and their boss said, no. Take last year's and update the numbers and give me that number. Don't waste your time. They were so disappointed. I had a student working for a major money center bank. Their equity cost of capital is 10%. I said, take advantage of this class and go ask them, how they came up with that number. And boy, he caused so many problems. He kept asking, no one knew. They kept going. He finally figured out. Someone said, someone in the 70s came up with that number, and we've just been using it ever since. That's a major money center bank that is supposed to be serving their stockholders. I shouldn't be saying that with Dr. Kazagam in here. But in practice, it is much sloppier than your classes, much less rigorous. So on the investment side and on the corporate side, but the 10-year is a good number. The 5-year tends to be a little too short and a little too volatile. The 30-year tends to be a supply demand number that's not all that economic.
That is beautiful.
1%. Yeah, I mean, when you get into practice, it's a little scary. The Tesoro CFO, her argument was, you guys are so theoretical, you can debate this forever. And I was like, yeah, it's subjective. No matter what you do, it's subjective. But we're talking about the single most important number for the corporation. You would think you would at least be rigorous about it and come up with a number that is reasonable and not just pulled out of thin air. I mean, the fact that this money center bank was using 10% when interest rates were 18% and using 10% and interest rates were 1% seems a little bizarre to me. But anyway. Yeah, so their cost of capital, equity cost of capital, was lower than the treasury rate for about 10 years of their history. Where do you get the market risk premium? Some of you had me before. What's the most common approach today? The implied approach. So, what is the implied? Anybody remember the implied approach? Now, when I started my career, it was this historical approach. Dr. Ibbotson, I've met him twice now. A really great guy. He's on podcasts. Really, really nice guy. he sold his firm to somebody, Moody's or somebody. But he was a historical one. Historical one's pretty easy. He just said, take the actual return on stocks historically, subtract the historical risk-free rate, and just assume what stockholders have made historically over treasuries is what they expect to make going forward. That's the historical approach. What's the implied approach? All right, so the implied approach, we're gonna get to that. It is a forecast going forward. But what is a market risk premium? It's the expected extra return over risk-free stockholders require to cover risk of investing in what? In Apple and Microsoft, investing in what? In the market, all right? It has nothing to do with individual stocks. It has to do with the market. So if the 10-year treasury is paying 4%, how much more should stocks be giving you as an expected return over 4% to induce you to take the risk of the stock market? Is that 1%? Is that 2%? Is it 5%? Is it 7%? How much more do you need? The implied report, the historic approach says, hey, we don't know what it is going forward, but we know what it is going historically. But we really don't know the historical number, do we? We don't know what stock investors required historical. We know what they got, but is it possible they got more than they required? That's certainly possible, right? So the fact that they made 5% over treasuries doesn't mean that's what required. They might have required 4% and they got a really good deal. So the historical report just historical approach just assumes they got what they expected. So what does the implied report approach say? Well, markets are what? Efficient. So the expected return on stocks should equal what? Required return stocks. Doesn't that make sense? If investors are expecting 10%, what would their required return be? 10%. If that's not the case, if they need 10% to cover risk and market's going to give them 8%, what are they going to do? They're going to sell all their stocks. What's the stock market going to do? It's going to drop until the price gets cheap enough until what? The expected return is 10%. If they expect 10% and the market's pricing them to give them 12%, what are they going to do? They're going to buy a lot of stocks. The stock prices are going to do what? Rise until their expected return does what? Falls from 12 back to 10. So that's what it says. So there's no place anywhere to get the required return on stocks. It doesn't exist, but we can come up with the expected return on stocks. All right, and this is where Emilio is going. So what's the expected return on stocks? What's the first part of that formula? Current yield. Current yield. Yeah, so what are stocks going to give you? Whatever the current yield is, plus expected earnings growth. Why did I say yields and not yield? Yeah. I don't know if I put the article in there. It's kind of an old article by Dr. Ibbotson and others did analysis of the buyback yield. It used not to be a big deal because for most years, firms were issuing more stock than were buying back. So it was actually not an impact. But the last 20 years, firms have actually been buying back more stock. They've been issuing. And that extra amount that they're buying back is actually higher than the dividend yield now. So you're actually getting more from buybacks. So how do buybacks impact you as an investor? With the firm buys back, what happens to earnings per share growth? It's going to be higher, right? Because per share, you have fewer shares. So the way you'll see the buyback is that earnings per share will grow faster than earnings because you're buying your shares back. So that's the long-term expected return on stocks. The dividend yield we can get very, very easily. I show you how to do that in the Excel file. We'll look at that here in a second. The buyback yield, you can take Ibbotson's number. It's about 1%, maybe 1.5%. what I did to update this number is I went up to the S&P 500, I took all stock buybacks versus stock issuance, and to see if it's changed much since he wrote the paper, and it really hasn't. It's been pretty stable. So you can probably use this number, even though it's a good decade old, you can probably still use this number fairly well. I mean, Ibbotson is the guru on this. He's retired now. His name's everywhere on anything related to CAPM. He gives you risk-free rates. He gives you market risk. He doesn't do the beta side of it, but that's his thing. And then expected earnings growth. That's a function of what? GDP growth. What grows faster, our economy or corporate earnings? So here is the green line is our economy. It's grown 6.4%. The red line is corporate earnings growth. It's grown 6.09%. So corporate earnings growth is about 6.1, economic growth about 6.4, which is more volatile. Corporate by far. What caused that big drop in 2008? One industry. 2008. Which ones? Financials and why? It's the accountant's fault. What did the accountants do to us in 2008?
Liquidity crisis caused by.
Not liquidity crisis. What did accountants change? How? What did they do? What did they do that they weren't doing before then that caused a disaster?
It's really all the accountant's fault.
100% the accountant's fault. What did they do? Have y'all heard of fair value accounting?
They turned it to.
They suddenly started taking unrealized losses on bonds and sticking them through the income statement. And caused huge loss. USAA, yeah, USAA is a $30-40 billion bond portfolio. It was down a few $2 billion. So that went to the income statement. And I was talking to Carson earlier, FAS 115, right? So if you're going to do banks and insurance companies, you better understand FAS 115 and FAS 157. Do you remember them, Carson? FAS 115?
Level 1, 2, and 3.
Yeah. How do you value the securities in 157? Held to maturity. Trading, what was the second one? Assets for sale, or available for sale. Yeah. This is what happened in 08, is if you're available for sale or you're trading, those unrealized losses are going to kill your earnings. So USA, you notice what happened in 2009, right? Corporate bonds sold off 10-20%. You had to write that down. In 2009, they came right back. So without that fair value accounting, you would hardly have even noticed 2008. So that's all insurance companies, maybe a little bit on banks, but yeah, huge. But you see some evidence here that corporate earnings growth is slightly slower than the economy. Now, how can that possibly be? Well, because this is the S&P 500. You got smaller firms, you have startup firms, you have non-publicly traded firms. They're growing probably a little faster than the economy. You bring it all together, corporate earnings probably grow about the same speed as the economy a bit. The S&P 500 is becoming more growthy now because of tech stocks somewhat taking over. But still, if you think our economy is going to grow 6%, corporate earnings are not going to grow 8%. It's just not going to happen over the long term. If corporate earnings grow much faster than the economy, then eventually you have no consumers and you're just all corporations. Maybe AI is going to do that to us, or robotics. Well, none of us will be working. Robotics will be doing everything. We'll just be sitting at home playing video games. Who knows? We'll be playing video games against what we think are our friends, and they're actually robots. So who knows what we're going to be doing in the future. But until then, your best estimate, in my belief, of corporate earnings growth is how fast is the economy growing. All right, so Emilio, you're ready? So economic growth is what? You had one of them. Which one? So labor growth. What was this first one? The most important for our wealth. So essentially, when you're trying to assess the overall stock market, not your individual stock, I mean, obviously Alphabet can grow 20, 30%, 5 or 6 years, but the overall economy, you have productivity, labor, and inflation. I know you have imports, exports. We're going to somewhat ignore that. It's kind of a noise on the outside there, but that's essentially it. If you look historically by decade, here's productivity growth. The blue productivity growth is average between 2.5, 3%. If we had a horrible productivity growth in the 10s through 20s, in fact, I tell people, The Economist, when President Obama in his last year, he wrote an article in The Economist, and they asked him, what was your biggest disappointment of your 8 years? And he said it was productivity. Why is productivity? It's not just in the US, but around the world. In the UK especially, just why is productivity? It seems shocking, doesn't it? In the age of the internet and all this stuff that's happening, how could productivity be so weak? Some people think the numbers are wrong. Y'all know how they calculate productivity? So productivity, you take real GDP growth and you subtract the growth in labor hours growth. So if the economy grew 4%, but we added 2% more labor hours, what is productivity? That's 2%. So that's all. And where does our wealth come from? It comes from productivity. The more productive you are, the wealthier you are, because you have more to share around. So productivity has been weak this last year. People think AI, robotics is going to improve, maybe autonomous vehicles, 3D printing, all these kind of stuff. You are starting to see productivity in some areas like construction that we haven't seen before, but it's been tough. What's the least productive part of the U.S. economy? Healthcare and education, those high service areas. So AI could transform healthcare. Education, who knows? I mean, I think I've asked y'all this question. Y'all think you'll be doing this? Students will be doing this 20 years from now? We'll probably give you a chip. You just plug it in and you got a PhD education. I don't know. But there have been some throws. I don't know if y'all saw. It was really interesting me watching the Alpha School in Austin. Really pretty interesting school. The kids do 3 hours in the morning on AI, and then the rest of the day they're just doing projects, and their STEM scores are way above all other schools. It's interesting. It's kind of fascinating. But yeah, part of the reason people think productivity in the U.S. is declining is because we become more of a service economy. In the service economy, you have more workers. It's just more difficult. I saw Walmart is announcing they're getting rid of their self-serve. That seems to be anti-productivity. You have more workers. So, I've seen kiosks at McDonald's that y'all talked about that right in your presentation. So, who knows? That's one thing that's really important for our economy. It's really important for your company. How are you going to do more with less? Robotics, AI, those type of things. So historically, our economy has grown about 6%, 2% from productivity, about 1.5% from labor, and about 2.5, 3% from inflation. Those are the pieces. Our economy, what was our number this last quarter? Remember it?
I think inflation 3%.
3.3. It was the original one was 3.2, and they adjusted it up to a surprising 3.5, 3.8. That's a really good number. What was it the first quarter? It was negative. Why was it negative the first quarter? This is what they're going to ask you in interviews. Why was GDP negative the first quarter? Around Liberation Day. Tariffs. What were firms doing? Buying a lot of imports. Why? Because of the tariffs. And what does that do? What is our economy? It's our economy minus imports plus exports. So yeah. So why was it so high in the second quarter? Because they didn't do all those imports, because they had low imports second quarter. So yeah, you need to know this stuff for interviews. It's really important. So 3.8 is a really strong number. So how do you get 3.8? And that's without the inflation piece, right? Did we have 3.8% productivity to second quarter? No, it was all the export imports noise. So can we get much higher than 2% productivity going forward? It kind of depends on your view of AI and robotics, 3D printing, all this kind of stuff. Now that the 3D printing houses, you know, it's getting kind of crazy. But that's what you got to think about. I think autonomous vehicles could be pretty important, but it keeps getting pushed back. But if AI really, really radically changes productivity, what does that mean for labor growth? Might actually be lower than normal, right? Labor growth is really, really high in the 60s and 70s. Where did that come from? Boomers, but even more than that, who joined the labor force in the 60s and 70s and 80s? Women, yeah. So we had, so can we do that again? Children, we can go back to child labor, so that could happen. But now we have baby boomers retiring, so that's definitely an issue. So you have some labor issues. You've got my life insurance class, we looked at replacement rates. The entire world is shrinking pretty dramatically. People are not having babies. In some countries like Japan, they're absolutely not having babies and shrinking. What does that mean for labor growth? And so AI might replace it. We may have more robotics, but they may just be replacing labor. So you get a bump in AI, but you get a shrinking in labor. That's great for productivity, right? You have more output with fewer workers, but it doesn't help the economic growth because you need people working, getting salaries and buying stuff. So you do have a challenge going forward. People think we're at this kind of really important inflection point of labor versus AI and robotics and what that's going to mean going forward. You know, we talked about those fulfillment centers, right? No lights, just computers running around. It's kind of freaky. Would you want to stand in one of those places at night with the lights out? It would be pretty freaky, wouldn't it? I mean, it's just like the stuff that's going around doing their stuff, and they probably know you're there and probably say, excuse me, and let me around. What that means going forward for productivity is pretty huge. So, you know, what can you get here? Maybe 2% productivity growth, maybe 1%. If you believe the Fed, you're talking about 5% economic growth. Since 6% historically, why is it lower? Because inflation was 3% historically. We think it can be 2%. So that drop from 6 to 5, most of that is just coming down on inflation. So, you know, can you really get 2% productivity and 1%? So people say, wow, we're so much more productive. We have all this technology. We got to be more productive going forward. And some people say, I don't think so. I don't think you can have the same impact of AI that they had when they introduced electricity, when they introduced refrigeration and air conditioning. How many of y'all, what was your productivity in San Antonio in 1940 with that air conditioning? Were you a very productive worker? Can you really get the kind of productivity gains that we saw earlier decades? I don't know if AI is there. So 5% to me, in my opinion, you're talking 4% to 6%. Above 6, I think, just mainly because that 6 we saw historically is with a 3.5% inflation number. You could say higher growth because they have more inflation, but inflation is kind of, you know, it's kind of a wash. Yeah, you have more growth, but you get eaten up because it's kind of fake growth. So, and then what's dividend yield plus the buyback yield? The dividend yield is right now really low, about 1%. Maybe you had 1%, maybe you had 1.5%, maybe that's 2.5%. So we're talking about corporate earnings growth. I mean, expected return somewhere in the 6 to 9% range. Expect return on stock somewhere in the 6 to 9% range. People say, yeah, but historically it made 10%. Yeah, and historically the dividend yield was 3, 4, 5% without the buyback. So you take the dividend yield plus the buyback, that's 2.5%. That's versus a 4% historically. So we're 1% higher just because the dividend yield is lower. Now, if the dividend yield is lower, maybe that means growth is higher, but we're not really seeing that in the numbers yet. So anyway, those are the numbers that you have to come back with to get your market risk premium. You have to ask. The implied approach says, what's a reasonable number for the expected return on stocks? You take that, that's risk-free rate. You got your market risk premium. The advantage you have in comparing companies is what? How do your risk-free rate and market risk premium vary as you look at different companies? What's the market risk premium for Walmart versus Ford? Exactly the same. What's the risk-free rate from Walmart versus Ford? The same. So the fortunate thing here is it doesn't impact your relative valuations that much. It does a little bit because your beta multiplied by the market risk premium is going to have an impact. Higher beta firm versus lower beta, so it can have that kind of impact. But fortunately, the risk-free and market risk premium is the same for everybody. So it really comes down to your beta that's going to really drive you. That's why when we do sensitivity analysis, we don't do it on the risk-free rate, the market risk premium, we do it on the beta, right? So the spreadsheet I showed you for valuation, it's tied to Bloomberg. You put your ticker in, it brings in the risk-free rate. It's the current 10-year treasury yield. The market risk premium, you can see the calculation in here. It just does exactly what I just did. You can walk through that. The video shows you how to do that, walks you through it. I'm using 4.25, so that gives me expected return on stocks of 8.24 or 8.34. You can use your own assumptions. That's fine. Just realize don't change them when you change stocks. Those that took my investment class, any student that started talking about their firm when they're doing the market risk premium is like, no, this has nothing to do with your firm. This is a typical investor. Now, this market risk premium is for what? S&P 500. What if you're doing a really small company? Do you need to add anything to that? Probably so. So where is small? If you're doing a $150 billion company, do you need to do an adjustment? Probably not. If you're doing a $1 billion company, maybe. I don't have that in the spreadsheet, but where would you go to get the small company adjustment? So you can do the motor in, equity, risk, premium, and he has all kinds of, he has country risk premiums, he has small cap risk premiums, he has it all out there, Excel spreadsheet. You're perfectly fine using his numbers, doing his numbers. You're going to do a firm in Brazil. There's a great, Embraer is in Brazil, great company, a global company producing really, really nice airplanes. Yeah, he would say you need to add an extra risk premium for Brazil. So keep that in mind. It's not in the spreadsheet. So we're assuming a firm that's in the S&P 500. So you may have to add an extra premium, but he does have, this is his country spread premium. He has, you could do cap premium. But he has them all in there. It's all for free. He shares everything. So then the next piece is beta. Is Walmart and Ford's beta going to be the same? That's where there's a difference, all right? So what did William Sharp say? This is, so I really love the book Capital Ideas by Peter Bernstein. He goes to, he teaches finance. I think we should almost teach finance the way he does. He teaches finance chronologically. So we discovered this, and so then we did this. And we discovered this, then we did this. So Markowitz discovered this in the 50s, and William Sharp came along and fixed it in the 60s by doing the capital asset pricing model. That to me is a really interesting way to go through how finance developed over time. So this is one of my questions, and when I interview people, I used to say, what is beta? And I'm expecting about a 20, 25-minute answer. So how long would your answer be on what is beta? Would you go 25 minutes? I've had Yale MBA students look at me blankly. I've had students from my class look at me blankly while I'm kicking them under the table. It's like, how'd you not believe that? We just talked about this last week. So beta is a pretty important number, isn't it? What would y'all say? What is beta?
They call it a regression, but I would say it's a forecast of the risk.
Okay, that's not a bad start. What could you put before risk? So, well, it's not, yeah, I mean, it's company specific versus systemic. Excludes what? So systemic is, it's we're talking the risk for a specific company, but a specific company's risk related to what? Is it their company specific risk? Or is it their systemic risk, the risk in the system? All right, so it's is it their diversifiable risk or their non-diversifiable risk? Non-diversifiable. All right, you're doing better than most of my previous classes. This is my thing about retention. We talk beta every single class, don't we, Dr. Cadbeck? There's probably not a class in finance we don't talk about beta. And then I interview seniors of finance and say, what is beta? And they look at me like, I never had that in any of my classes. Yeah, you had it every one of your classes. So it's a forecast. You can say it's a measure of or a forecast of non-diversified risk of what? An individual stock. So how much of that stock, what that stock's risk that we care about, that's non-diversifiable, that's what beta is measured. It excludes company specific risk. What is company specific risk?
CEO.
CEO quits. They have some major government shutdown or something, or some government comes in and shuts them down for some violation of some rules. So for banks, a bank gets penalized by the SEC or by the bank regulators for some fraudulent thing that be company specific. The Fed changing interest rates, is that systemic or company specific? That's systemic. Interest rates is a systemic risk. Inflation, tariffs, would that be systemic? Is there a firm out there not worried about tariffs? So important, what percentage of a firm's risk, and the firm total risk is what? It's the standard deviation of the stock price, right? It's how volatile the company is. How much of that is systemic? Systemic. Yeah, somewhere at 15 to 25%. The majority of the risk of a company is diversifiable. It goes away when you put that stock into a well-diversified portfolio. So that's pretty amazing, isn't it? So when you just simply by putting a stock in a portfolio of 80 other stocks, 70–80% of that stock's risk just completely disappears. And all you care about is that part of the risk that's somewhat tied to a systemic risk.
You want to see like industry data?
No, you can use a company specific data. Yeah. We're not valuing the semiconductor. You could do that with ETFs if you want to do, but no, it's company. Now, there are industry, I'm going to show you how I do beta that you can kind of look at that a little bit. Anybody remember how do you figure out the systemic part of this? Huh? Well, that's how you define them, but how you figure out this 15 to 25%? It's a really, really easy calculation. So it's the R squared, the company stock returns, the S&P. You just calculate that R squared and it tells you how much of it is systematic risk. So you can do that. If you read some of y'all took my risk management class, we talked about this. That systematic piece of the risk, what does it do in a crisis? So on average, a company's systematic risk is 20% and diversifiable is 80%. What happens in a crisis like 2008 to that systemic part? It rises up to 40, 50, 60%. So as I say in finance, our tools in finance to manage the risk, they work really well except for when in a crisis, when you really need them. So yeah, 2008, you didn't get that wonderful diversification benefit. Stocks just fell. Walmart was the one S&P stock up in 2008. Everything else was down pretty dramatically. So yes, the systematic, this R squared rises in a crisis, which means that diversification benefit helps you the least when you need it the most. It's just kind of frustration. of tail events. So beta is a measure of the risk the firm has that is tied to systematic events. We tend to think the economy is the biggest systematic event. So to Emilio's point, you can think of stocks in two categories. We have cyclical and defensive stocks. So, Colby, your sector, what are y'all, defensive or cyclical?
For, it's like part of that airline.
Yeah, you got airlines, restaurants. You're consumer discretionary, right? Yeah, so defensive or cyclical? Cyclical almost by definition. And Emilio, what are y'all? Your staples, right? You're doing discount stores. So, so you know, there is a sense. When I hear a stock name, I think of a beta pretty quickly. Now, sometimes I get tricked. Tim Hendren. Oh, we're out of time. We'll get into this more. I even wear my t-shirt, but I'll show you my t-shirt on next Tuesday. So we'll finish this up, but we'll get pretty close to finishing all the valuation next Tuesday.